Top 3 things for individual investors to consider before you make your investment decisions over the next couple of weeks. And as you recall, our last show, we actually had a top 5 list for 2026. We're now back to more, every 2 weeks, giving you a list of a few things that I think you need to be watching or be mindful of. So here is our list for today. Economic data out of Canada and the US. What economic data? We got a big jobs number report coming out this Friday. Jobs Friday, as we like to say, in Canada and the US. And we also have very important inflation data coming out next week in the US as well. So we're going to touch on that information. Markets still have a bit of a hangover from 2025. When we were putting together our first show of this year, we were kind of all coming to the same conclusion. The same topics that were important at the end of last year were pretty much the topics the market's focusing on this year. Bit of a hangover from last year. So we're going to talk a bit about that. What is the January effect? And what is the January Barometer, and why is it important for investors? We tend to talk about the January effect every start of every year. And I think it's important because it's a positive indicator, and the market tends to follow more often than not the January Barometer. So let's get into our first topic, economic data. And as I said, economic data out of Canada and the US, jobs Friday, December jobs coming out January the 9th. And then we have US CPI, or Consumer Price Index, coming out next week, June 13th. And Canadian CPI looks like won't be coming out till the following week on January the 19th. So why is it so important, this jobs number? Well, today we heard that the United States private payroll number came in a little bit disappointing. ADP came in a little disappointing in the US. So that meant that private companies, not publicly traded, but private sector payrolls were down more than the market was anticipating. How will that play out when we look to Friday? Well, we'll just have to see. Our first chart is one that goes through US jobs by month. And look at that scrambly, look at that up and down towards the end of last year. A lot of that had to do with the government being shut down. Information was not given. Information was not, as many believe, as accurate as we would like to see. And so we had jobs being down and then up and then down and then up. And it was all over the place. And I think this Friday could be, in my opinion, the first, I guess, more accurate number. Obviously, the U.S. government, it has been open now for quite some time, many days. And so we should get an accurate report out of December. And I've heard a few economists talking about how the first quarter of 2026 will give us a really good picture as to how jobs are doing and what the job creation looks like in the United States. Let's move over to Canadian employment data. And there you have it. Look at the growth in jobs, September, October, and November. Our government was not shut down, so we're relying on this data to be accurate. I was talking to some individuals recently, and they're actually questioning some of the data. They're saying that, yes, maybe the headline number looks pretty strong, but they're actually questioning just how strong it is. Some of the recent jobs growth last month came actually in, most of the jobs growth, if not all, came in the part-time area, which is not what you want to see. Also, in October, a lot of that growth came in the part-time area as well. The good part about it was we actually saw some pickup in jobs in the student-led area. Students looking for jobs, young adults looking for jobs. We actually saw a bit of a pickup there, which is great, but on the part-time side, not the full-time side. Remember, our unemployment rate went from 6.9% down to 6.5%, something that I don't recall seeing. I guess a pullback or a fall of 0.4% in just 1 month. Great to see, but I think a lot of people are questioning it. So let's see what the number looks like on Friday. If it's another great number, it will definitely go a long way to back up the numbers that we saw at the end of last year. Our next chart, U.S. Consumer Price Index, U.S. CPI. You can see it there, that less food and energy, which is core, which is what the Fed looks at, 2.7%. The headline number, 2.6. that has come down quite nicely since it was 3% just a few months ago. And again, some people are questioning the accuracy of the data in the US, obviously because of the government shutdown. Canada's annual inflation rate, our next chart, we can pull that up. It looks like there it is. It's come down nicely as well. The headline number, 2.2%. So just above the target, which is 2%, and the core number, 2.8%. That to me is coming down as well. It was 3% core for a little while there as well. So major data, or very important data, coming down the pipe over the next few days with jobs, and then next week, I say US inflation, and the week after, Canadian inflation. This is what the Bank of Canada and the Federal Reserve are going to be looking at. And just one aside here, I saw a press conference from Premier Doug Ford, and I think he hit the nail on the head. He talked about cutting taxes, putting more money in the hands of individuals living in this country. We know GDP or growth is stagnant, maybe 1% at best this coming year. That's the prediction. Perhaps some of the data coming out, jobs, inflation, maybe that'll give ammunition to the Bank of Canada to start cutting rates again, hopefully making things a little bit better for all of us living in Canada. And if the federal government would also back that up with a tax cut, I think this country could come roaring back with a lot more growth. So hopefully we see government help and assist with growing GDP, and helping private businesses, helping public businesses, helping businesses want, or making businesses want to do business with us here in Canada. Our next topic or point, or second point, that individual investors need to focus on before they make their investment decisions, and that is markets are still in a hangover. And why did I put this for today? Well, we're still in this tech hangover. Anything tech, anything AI, AI all day for all people. I think that was a quote by Lisa Su from AMD. She said that at the CES show, Consumer Electronics Show, this last couple of days. And really, the hangover continues. It's all about AI. It's all about tech. And yes, I think this is going to continue. This will not change. I know towards the end of last year, we were a bit of a holding pattern. There wasn't much of a catalyst for investors. I think there was a lack of a catalyst. We didn't see really a Santa Claus rally, kind of flatlined the last part of 2025. But here we are in 2026. We have the Consumer Electronics Show, which we'll touch on a little later in our show here. We have taxes coming down in the United States. No tax on tips, no tax on overtime. The great big beautiful bill, as the president calls it, kicking in. We have a lot of AI, and things are becoming more efficient, and money being saved right across the board in many areas for businesses. So a lot of good things going on, and a lot of that will hopefully spur on growth and hopefully be a catalyst for 2025. I listed here in our first illustration, I guess, some potential market catalysts for 2025. And here you have them. Strong quarterly earnings. We're going to get earnings kick off our start in a couple of weeks. Usually JP Morgan kicks off the earnings season. The big banks in the United States kick off the earnings season. We'll see how they go. Hopefully it could be another positive and strong quarter, fourth quarter of last year. The new Fed chair assumes his role this year. That person promises to be more dovish, more in the area of cutting interest rates versus raising them or keeping them the same. I think President Trump is going to elect somebody who is willing to continue to cut rates and stimulate the economy. Fed policy rate changes that hopefully will come from the current Federal Reserve Board. If no changes are made or cuts made before the new Fed chairman comes in, I think the market is expecting a couple of cuts for the year. Let's not forget Supreme Court decision on Trump reciprocal tariffs. Supreme Court still has not ruled on whether the Trump tariffs are legitimate or legal and could be done. I've been hearing that we may hear something from the Supreme Court as early as Friday of this week. but I've heard some deadlines in the past and they've come and gone. So we'll see what the Supreme Court says. And last but not least, as a catalyst, major geopolitical event. Well, we saw one recently, right? The United States going into Venezuela, removing their leader from power. And is that a catalyst? Perhaps. Is that a catalyst for oil companies? Perhaps. Or perhaps it is a negative for oil companies. And we'll touch on that a little later in the show. So, we are in a bit of a hangover. I think individual investors need to understand that. And but the good news is we seem to be coming out a little bit. A lot of good news in tech land has helped the markets move higher. Our third and final point that individual investors need to understand before they make their investment decisions is the January effect and January barometer. What is the January effect? Simply put, it is, as we can put up the definition of January effect, there it is, the supposed tendency of stock prices to rise in the first month of the year. Why do they rise? Well, we don't know exactly why prices rise or the markets go higher. We know that the first 2 weeks of January sets the tone for the rest of the month, and the month of January sets the tone for the rest of the year, which we'll get to in a second. Is called the January Barometer. But we don't know exactly why January is a good month. Perhaps it's all that tax loss selling that individual investors do in December. Well, maybe people start buying back in after 30 days in January. We also know that it's a new year, a new beginning for many people. Perhaps people look to make their RSP contributions, look to make contributions to their portfolio, to their tax-free savings account, and all the different types of accounts that exist today. So maybe it's just because, simply put, a lot of money starts looking for a home at the beginning of a new year. Smaller companies tend to do better than larger companies for obvious reasons, right? Not as many shares outstanding, not as much in the way of shares trading, and so small companies tend to do better than large companies. Let's move on to our next definition, and that is on the January barometer. And here it is. Some traders believe that the S&P 500 index January performance can predict its performance for the rest of the year. So, for example, proponents of this January barometer believe that if the S&P rises between Jan 1 and Jan 31st, this will foretell a positive result for the remainder of the year. Similarly, it holds that if the market fares poorly in January, it likely will perform poorly for the rest of the year. Key takeaways: the January barometer is a market hypothesis stating that returns in the January predict those for the rest of the year. It is popular among some traders, and it was first set out in the Stock Traders Almanac. The January barometer is predominantly a U.S. phenomenon associated with the S&P 500. So as goes January, goes the rest of the year. And I've actually seen or read about if January actually has a negative return, it doesn't necessarily mean that the rest of the year is negative, because we have seen comebacks for the market after a negative January. But if January is a positive, I think it's something like between 70 and 80% of the time, you're going to get a positive year. And I believe last year was a positive January, and then markets fell in the spring and then rallied pretty much the rest of the way. So let's keep an eye on things such as the January effect over the next few days. Let's keep an eye on the month of January as a good barometer for the rest of the year. We obviously know that the markets are in, or continue to be in, this tech hangover, if we want to call it a tech hangover. But the good news is, with a lot of tech announcements recently, markets are doing quite well. And economic data, that is probably going to be the first thing that we want to focus on before we make our investment decisions. Come this Friday, we're going to get some key economic data, some key jobs data out of the US and Canada, and it definitely promises to be a market mover.